We can hear you now. I can hear you now.
All right, fantastic. Is it better now for everybody? Okay, good. So, like I was saying, that is the objective of the standard, not to beat around the bush. The objective is, in the case of, let's say, for instance, equity co, you want to, the standard is saying, I want to give you the basis to determine the number of shares that you are going to use in the calculation of your EPS. Now, what is earnings per share? We all know that earning per share, I don't know if Mr. Wasu already taught you ratio analysis, but we have been doing ratio analysis for a while now. We all know that earnings per share is usually the profit attributable to ordinary shareholders divided by number of shares. I'm just going to say number of shares for now, because that's what we normally do. We either say profit after tax divided by number of shares, or we say profit attributable to ordinary shareholders. Now, the reason we normally use the profit for the year or profit after tax is that when you look at your profit after tax, you have made all deductions to different stakeholders from it. Number one, you would have started from your suppliers, Abi, your cost of goods sold, right? You would have made that deduction from it. You would have gone ahead to make your day-to-day operating expenses, your administrative expenses that you are going to make to different provider of the utilities that you use, your finance costs, interest expense. You would have also made that deduction, Abi. Then you would have gone ahead after you have paid all these people. You have made a deduction for payments that is supposed to be made to all these people. You will now go ahead and do an amount, an estimate of what you are supposed to pay as tax to the government. Now, whatever is left is supposed to be profit that is attributable to who? To the shareholders, the ordinary shareholders. Now, could there be other appropriations? It may be possible even after you have had your profit after tax. So the standard is very, very careful to say this profit, this numerator in this formula has to be profit that is attributable to ordinary shareholders. It could be your profit after tax. It could be your adjusted profit after tax. It could be your your profit after tax after appropriations, whatever appropriations they could be or adjustment they could be. What the standard is all about is that that numerator should be profit that, so that you know that this EPS is only concerned about the earnings that are supposed to be distributed or that are distributable to ordinary shareholders. Ordinary shareholders. So the next level will be, what is ordinary shares? How does the standard define ordinary shares? The standard says that ordinary shares is an equity instrument that is subordinate to all other classes of equity instruments. All right. Now, what does this mean? The standard is also being very careful, but yet it's being definite in what it is defining as ordinary shares, meaning that all of this grammar, all of this summary they have done, what they are trying to tell you is that it is subordinate in that when you are going to make, when everybody that has a claim or an investment or a capital contribution to the entity will get their reward, the last consideration will be the ordinary shares. That is why we say the ordinary shareholders are the real risk bearer of the entity or the company, because when you would have settled all other classes of whether investors or third-party capital contributors, meaning your liabilities. When you would have settled all of that, it is when you have done all of that that you will now think about the ordinary share holding. All right. So the standard says it is an equity instrument that is subordinate to all other classes of equity instruments. I don't see ICAN asking you to define it, but it's just important. But what is also very important to note here is potential ordinary share. Now, the standard recognizes, you would have dealt with this with Mr. Wasiu under IFRS 9. In IFRS 9, I'm sure when financial assets were defined to you, they would have told you contract, it must be a contract that is going to lead to, getting maybe interest or dividend or blah, blah, blah. But you would have also been told that there are some instruments that are quite composite in nature. For example, what are we saying here? You could have a bond that is a convertible bond, meaning that you may have the holder of that instrument, equity and convertible bond, could have a right, not an obligation, a right to decide at a particular period of time to convert their bonds to equity, meaning that at this particular date, given the market price of these shares, I am no longer going to be, because what bond means is that I lent money to the company, but immediately I become an equity holder, an ordinary equity holder or ordinary share holder, I become part of the owners of the company. I will no longer be entitled to the coupons or interest that the company was supposed to pay me. Now I am expected to get dividend or make my capital gain by selling my shares. Those are the only two ways ordinary shareholders get their return. They either get their return by dividend or they get their return by having to make a capital gain or loss, if the case may be, meaning that I am going to sell my equity position to somebody else and I will no longer be the owner of that equity. So either I do that and try to make some capital gains by doing that, or I wait until dividend is distributed. All right. Then we have options, warrants, and their equivalents. So these are financial instruments that give the holder right to purchase ordinary shares. It gives them the right to purchase ordinary shares. But then we have put options, which gives them the right to sell their ordinary shares at a particular price or for a given period of time. Now, what you will notice here is that the four things that have been defined here have a chance, a probability to affect what I said is the core reason why you are doing this standard. This standard is aimed at helping you to determine the what? The number of shares that should be used in the calculation of earnings per share. So the number of ordinary shares matter to us because that is the exact index that we need to calculate EPS. The potential ordinary shares matter because it gives us an indication that there is the possibility that some people who hold convertible bonds, who hold options, who hold warrants, or their equivalents may at any point in time decide to convert those instruments to become shares. And what is that? The meaning of that is that it is going to immediately affect the number of shares that we have. So the standard is going to tell us what we are going to do about them. Even though as of now, those instruments have not been converted to equity, but there is a chance, there is a possibility that in the future they will. So therefore, they have the potential to affect the number of ordinary shares. All right. So the standard is going to give us an indication of what to do when we get there. I just want us to move on. All right. So this part is just to explain to us what those potential ordinary shares could be And the standard did mention that it could be debts, financial liabilities, or equity instruments, including preference shares that are convertible into ordinary shares. He made mention of share warrants and options. Then he went ahead to say shares that would be issued upon the satisfaction of certain conditions resulting from contractual arrangements, such as the purchase of a business or other assets. Now, another one you could have here, another example for C could be, I'm sure you must have dealt with share-based payments, some share-based payments. So if there are certain conditions that once they are fulfilled, it may trigger the sale of shares, then you also take that as potential ordinary shares. They have not become ordinary shares yet because those things have not been triggered, or those rights have not been, or those claims have not been triggered. However, there is a tendency that they will become ordinary shares in the future. Now, the standard also went ahead to tell us what is the scope. Now, IAS 33 does not apply to every company. So you may work as an accountant all your life and you may never have to deal. It's a very simple standard, but at the same time, you may never really have to deal with it as much. Because if you don't work with a company that is a quoted company, meaning that a company that is shares, the shares of that company is traded on the floor of Nigeria Stock Exchange or the stock exchange of that country you are working, you may never have to really deal with IAS 33. So the standard went ahead to say there are some restrictions. This standard is only for companies with potential ordinary shares which are traded, needed to present need to present EPS. Said EPS need only be presented based on consolidated results where parents' results are also shown. Said where companies choose to present EPS even when they have no potential ordinary shares that are traded, they must do so per IAS 33. So if you are choosing to present EPS as part of your financial statement, you can choose not to. But if you must show us your EPS, you must say this is our earnings per share. Then you have to do so following the rule of IAS 33, following what IAS 33 prescribes. However, if the shares of that company is not traded, if it's a private company, that is all I'm trying to say. If it is not that your company, at the same time, if it is also not that, if you are a private company and you are in the process of, you are filing and registering with NGX so that you can become a publicly quoted company, then in that year, that financial year, whether you have now become a publicly quoted company or not, you'll be expected to follow IAS 33 and as it has been prescribed, do everything that has been prescribed there. All right. Now, I'm going to jump a little bit. So that we can move past. Okay. To calculate, I'm looking at earnings now. To calculate your basic, so there are two types of EPS. Let me quickly mention that here. We are about to start with the first one. There are two types. So there's one called basic, and then there's another one called the diluted EPS. The basic and the diluted EPS. Now, the basic EPS, we're going to look at it as though we will look at basic EPS as though we will not consider potential ordinary shares. I made mention of the fact that the standard will give us guidance as what to do when you have potential ordinary shares. When we talk about potential ordinary shares, this note gave us, or this standard gave us, what are those potential ordinary shares. You have convertible preference shares, convertible bonds, share warrant and options, they gave us an example. They also said, most loosely, they now mentioned that there could be any contract that could trigger, that could be that maybe you have terms inside that contract that can trigger, the purchase of or the ownership of some shares. All right. If you have that, we have what we call potential ordinary shares. All right. Now, basic EPS does not consider that, but diluted EPS does. Diluted EPS does. Meaning that in calculating your diluted EPS, you are going to have to make adjustments or factor in the fact that there are some potential ordinary shares that you are likely going to have. All right. Now let's look at earnings here. They say to calculate your basic EPS, the amounts attributable to ordinary equity holders of the parent entity in respect of, you have to consider these two things: the profit or loss from continuing operations attributable to the parent entity, then profit or loss attributable to the parent entity. Now, the amounts in A and B shall be adjusted for the after-tax amount of the preference dividend. Now, all of this is just to say that your earnings have to be earnings that are attributable only to the ordinary shareholders. All that English is just to say, if you have any preference dividend or preference whatever, you have to make adjustment for it. That profit has to be, that numerator that I mentioned here has to be the profit that is attributable to ordinary shareholders. All right. Away from that, let's look at the main stuff here. Now, what is the main stuff that we are looking at here? The standard says that if we want to calculate our basic EPS, we must consider the number of ordinary shares, and it has to be one-us. I call it one-us. What is the meaning of one-us? I call it one-us. It means weighted average number of ordinary shares outstanding. Weighted average number of ordinary shares outstanding. That's the meaning. So what is the meaning of weighted average number of ordinary shares outstanding? Let's look at this. Let's say example. Marian Co., a listed company, has the following share transactions during 2007. Now, date 1st January, balance at the beginning of the year. They have all the issued shares they have in the company was 170,000 issued shares. Then 31st May 2007, they have now issued new shares for cash, 80,000 shares. And so by the end of the year, reasonably, they had 250,000 ordinary shares, which must have been the addition of this 170 plus this 80 new shares that were issued, and that would have totaled 250,000 ordinary shares. All right. Now you are asked to calculate the weighted average number of shares outstanding for 2007. Now, let me just tell you the secret. The difference between number of ordinary shares that you have at the end of the year and what the standard is prescribing, which is your one-us, weighted average number of ordinary shares. The difference between them is that the weighted average number of ordinary shares takes into consideration the time factor. The time factor. You see, let me quickly explain this. These 80,000 shares that were bought May 31st. Now, if the company were to pay dividend from the profits of the previous year, so when let's say the company maintains their account till the financial year end of the company is, let's say, 31st March, you cannot possibly come 31st. So in practice, what happens is, if they have a financial year end, they want to share profits, they will have made known a particular date, meaning that if those shares, you did not have those shares as at that day, you will not qualify for dividend, meaning any new share that was issued after that date, the holders do not qualify to have dividend. Only the existing ones as of that day, meaning that only this 170,000 shares, the holders of these 70,000 shares units will be qualified to get dividend. So therefore, in using the number of ordinary shares to calculate, then we must pay attention to the timing. There's a timing factor that we must pay attention to. Now let's look at it like this. For shares that existed from January 1st, 2007 down to 31st December 2007, this 170,000, they existed throughout the year. But if you look at this one that came in 31st May 2007, they existed for how many months? We will count June, that's 1, July 2, August, that's 3, September, that's 4, October, that's 5, November, that's 6, September, that's 7, meaning that they existed for 7 months. They existed for 7 months. So what I will simply do is to say, okay, this is the situation we have here. We have a situation where we have 170. Let me reduce this. We have 170,000 shares for 12 months. So I can say 12 over 12. Put this in brackets. And then we now have, at the end of the year, we have 250,000 shares for how many months? For 7 months. We have a total of 250 shares for 7 months. All right. Now let's do this. What do we have? Is my calculator up? Okay. I'll just use maybe my Excel. So we have 170,000 for 12 months. All right. So I can say this. Okay. Excel has turned it to dates. I can say times this. This is 1 full year. I can leave it at this. Okay. Sorry. Okay. And then we now have at the end of the year 250. But this 250 was for 7 out of 12 months. All right. Sorry. Did I put 2.5 here? Hello, can you hear me?
Yes, we can.
Yes.
All right. Okay, so we had this, sorry. This 170,000 existed not for the whole year, it existed up until May. Abi? I'm coming. your weighted average will now be the sum here. Or we can decide to look at it differently. We can look at it like this. Out of the 250 we had at the end of the year, we had 170 existing. We can assume that, okay, that's another way to look at it, that this existed throughout the year, but we added 80,000. Those 80,000 existed for only 7 out of 12. Abi? All right. I think we should have the same value. So either we look at it like this, meaning that I'm going to break it up and say out of the 250 we have at the end of the year, out of the 250 we had at the end of the year, 170 is existing. It remained existing to the end of the year. However, we issued 80,000 during the year, which is from May, right, till December. From May 31st, rather, to December, we counted 7 months. So I drew a proration. So at the end of the day, this is going to be my weighted average number of shares. Is this clear? Or you need me to explain again?
So how did you get 0.42, please?
Okay. Excel immediately converted it. Let me write it out like this.
5/12.
Yes, 5/12. So this is what I did. But Excel turned that 5/12 to decimal. I think I should be able to change it to fraction. Let me see if we can go back to fraction. It can. But it's giving it as 3/7. Don't worry. Is this clear?
Yes, sir. Thank you.
All right. So let's move on. So if we know how to calculate the number of weighted average number of shares, ordinary shares, that we must consider when these shares became issued, all right, it's easy, it's straightforward. Let me say it again because I almost made a mistake there. Either we are looking at it like this. This is our total holding. It was there for 5 months, 5/12. Or we are looking at it like this. I want to break up my total at the end of the year into how they came in. And that means I will consider this 170 on a breakup basis. It actually existed throughout the year, if I'm looking at it that way. Or, and I will now say 80,000 came in. 80,000 came in for 7 months. If I do it that way, it means that what I'm even saying here is that 250 is what I have for how many months? For 7 months. The day they added 80,000 to it, it became 250, and that was May 31st. So from that May 31st down to December 31st, they have 250 for 7 months. The total they had for 5 months was 170. So this will total to this is fine. Or you can break it up, meaning what did we have before? What was added? Okay, you want to use what was added. You can also go this route. Whichever route you go, it makes sense. All right, let's move on. Now, we could have changes in shares without corresponding changes in resources. All right, what they are saying here is very simple. We are looking at bonus shares. We are looking at right issue. Now, what is the meaning of bonus shares? Bonus shares means the company decides, for instance, a company that did that of recent is UCAP. United, it's a subsidiary or an affiliate of United Bank for Africa, UBA. They have a company that is meant for, we call them capital market operations. It's the industry I also work. They deal with investments, shares, and all of that. They deal with buying bonds, T-bills for customers, and all of that, right? And they decided that we have existing shareholders and we are going to do something. We're going to redominate our shares. We'll give them bonus shares. At times they call it stock dividend. Very common to call it stock dividend in America. Stock dividend meaning that if you own a number of shares with us, we are going to add additional units of shares to you. For instance, if you own, I think it was mentioned here, okay, even the example here, say Greco add 400,000 shares in issue until on 30th September 2002. It made a bonus issue of 1 for 4. The meaning of 1 for 4 here is that we are going to give you one added shares for every 4 units of shares you own. For every 4 units of shares you own, we are going to give you 1 added shares. What does that mean? If I own, it means that if I own, let's say for instance, 200,000 shares before, what will be my number of added shares? It's very simple. You said for every shares that I own, you will give me 1 new share. So the number of shares you are going to add to me will be 1/4. It will be 1 for every 4 multiplied by 200,000. And that will give me 50,000 shares. Now it is those 50,000 shares that will be added to me. Thank you, Madam Ayola. It is those new. Now my new shares will now be 200,000 plus these new shares, meaning I now have 250 shares. 250 shares. Now I want to ask a very simple question. I want to ask a very simple question. And this question used to cause a bit of argument in the past. My question goes thus. If you are the accountant of, let's say, Ewenjewe, funny name, right? Ewenjewe PLC, and you have shares, 200,000 shares with UCAP. UCAP has decided to do this policy of, for every 4 shares, we are going to give you 1 bonus share. And they have done that. It has been communicated to you, your company, you saw it. Oh, we have shares there. We have 50,000 new shares. What are you going to do? Or are you going to do nothing? How are you going to account for this new 50,000 shares? I want to hear 1 or 2 persons before we move on. You can use the chat box. Nobody's saying anything, K. How would you account for it? Oh, yeah, go ahead, please.
So I think it is going to add to the number of shares now, even though it is not paid for.
No, I'm not. Okay, we are still going to come back to that one. You are speaking from the company. You are speaking from the viewpoint of the company that issued the shares. They issued the bonus. I'm saying you have a financial asset, equity instrument. If you are the one that bought 200,000 shares from UCAP, so you are not the one that issued the new shares. The new shares was given to you as bonus. how will you account for that bonus shares? Not as the company. You are not the accountant of the company that issued the shares. I don't know if you guys understand what I'm saying here.
Yeah.
Anybody wants to try?
So I think you're going to credit your equity instrument with the 50,000.
Don't make mistake. This 50,000 is number of shares. It's not money. It's not money. It's just number of shares. And if you credit equity, you are reducing the value of your. Okay, let me help
No,
us.
sorry, sir.
Go ahead. I'm listening.
You are to credit your reserve because I believe issuing bonus is from reserves.
Okay. I may not be able to win with this digression I have made now. So most of us are used to seeing equity from the angle of the company that is issuing the equities. You are all of us that are still speaking, the two persons that have spoken now, you are still speaking, or three, you are still speaking from the angle of the company that issued the shares. Take your mind away from what we are doing for 1 minute and reason as the accountant of the company that invested. So it's not just it is equity investment. God bless you. So you just put equity investment. You debit equity investment. Equity investment is an investment. So it's an asset to you. To the company that issued it, it is equity. So they can, when you want to increase equity, you debit. You credit rather. But when it is an equity investment that you have made, you will do it by saying it's an asset. So I want to increase my asset. I will say these 50,000 new shares that they have given me for free, it has a market value. I can decide to sell it. They have given me mine now. So therefore, my assets should reflect that I have increased in the value of my equity investment. So what do? I will debit equity investment, and then I'll credit the income side. Now, before in the past, people will say, because it is not cash. No, no, no. There's no argument of such any longer. There's nothing like that. And I'm only asking because UCAP did it, and one of the companies I work with also have UCAP shares in their position. And we didn't find out on time, but during the audit, we needed to account for it. And that was what we did. It's very simple and straightforward. Now, let's come back to EPS. Now, let's look at it from the angle of the company that issued the shares. From the angle of the company that issued the shares. No problem at all. It's not there's nothing tricky about it. Do you understand? There's nothing tricky about this question. This question just means, like I said, that you are going to, the question here is not complete, or I didn't make it more than this, because I just wanted to show you that all you need to do is to say, how many shares do we have in issue? We have 400,000. Now that we have issued 144, the additional number of shares, added number of shares will be equals to 1 divided by 4 multiplied by 400,000. Multiplied by 400,000. And that will be 100,000 new shares. Now, what is the standard saying about this 100,000 new shares? Of course, it is going to affect, it is straightforward. It is going to affect your weighted average number of shares in the current year. But not only that, because you are not only comparing your EPS with the EPS of other company. Most importantly, in your FS, you are not even comparing with other company in your financial statement. You are comparing it with the previous year's EPS. So that page where you do your financial 5-year financial summary is not part of IFRS though, but it is part of our local disclosures, all right, which you must note for your exam as well for CR students. So that 5-year financial summary that you are going to do, you will most likely calculate EPS for each of those years. Now, what it means, therefore, is that the standard does not even say you should go back to 3-4 years back. But the standard says for the preceding year, I will need to go back because this bonus has increased the number of shares that I have. But it has not come with any cash. It has not come with any resources. I have only offered it for free. Now, the fact that I have offered it for free, I need to go back to the previous year and increase the number of shares for the previous year by this same 100,000 so that they can be balanced. When I'm comparing, let's say for instance, this is 2002, Abi. Now, the corresponding figure for 2001 will also be 500,000. This will be 500,000 for 2002. It will also be 2001. It will also be 500,000. Why? Because we increase the number of shares. Numerator increase. Denominator increase, meaning that number of shares increase, but the capital contribution has not increased. So if I want to have a balanced basis of comparing the previous year and the current year, what I should do is to go back to that previous year and also divide it by, I'm going to have to adjust my EPS now. I will now divide, if I divided by 400,000 shares before, now I have to divide the profit attributable to ordinary shareholders by 500,000. I will go back and adjust it. And the reason for that is that if I don't do it that way, there would not have been a good basis of comparing those EPS. It will, because what will happen is that in your current year, it will now look as though if you have not made enough profit to account for the increase in number of shares, it will now look as though your EPS came down. So to have a good basis for comparison, the standard say go back and add it. Another thing is that for bonus shares, they say the weighted average, look at this point here, the weighted average number of shares will be calculated without due consideration to the time weighting factor. Furthermore, the weighted average number of shares of the immediately preceding period will be adjusted for the effect of these events. All right. Okay. Is this clear? I move on. Because for bonus share, it's quite straightforward. I'm not adjusting for time factor, number one. Number two is that number of shares, those number of shares that were added, I will assume that they were also added to the previous year number of shares. And then I will do a recalculation of the EPS of the previous year. Now, let me put number to it here. It's not clear. Okay, let me go back to it again. In essence, what I'm saying is this. The number of bonus shares that was added here, we calculated it to be 100. Now, for 20x2, the number of shares, your one-us, will be equals to the 400,000 shares you had before, plus this additional bonus shares, all right? And that will give us 500,000 shares. Now, this number of shares, the standard said two things. That this number of shares that you have here, this 100,000, don't worry about the weighting factor or timing factor like we did here. Say don't worry about it. Don't worry about this factor here. Don't time it. Number one. Number two is that the previous year, you probably have calculated, let's say for instance, let me put number to it so that we can work with it. Let me put numbers to it. Let me just copy this now. So I'll copy this. Let me take it to that Excel and I'll put numbers to it. Let me give us a perfect scenario for what I'm talking about. All right. So let me see, what can I add? Okay, let's say calculate the EPS. Let's solve for EPS there so that it can be much more clearer. And the corresponding, calculate the EPS and the corresponding figure for 20x1. Let's say total earnings were 800,000. In the current year, and let's say EPS in 20x1 was 18 naira 75 kobo. Okay, let's say you have been told, even though it does not matter, the company year end is 31st December. All right, now this is what I'm saying. This is what I'm saying. Now, I can come here and say current year. All right. Ordinary shares that they had prior. Ordinary shares prior to bonus. Prior to bonus was how much? They had 400,000. All right. I don't want this. Now, bonus that was issued during the year was 400,000 multiplied by 1 for every 4. Abi, that's 1 over 4. And that gave us 100,000. Abi? Now,
Yes,
this is
sir.
what I'm saying. If you go by what I taught you earlier, we can't just say this is our one-offs. What would we have done? We would have come back here and say, when did they issue the bonus? They issued it 30th September. Ordinarily, I would have said that I should do a weighting factor here, which is to say, okay, we had 400,000 shares for how many months? We had it for 9 months. I would have said 9 over 12. Abi, isn't it? And then I would have come here and say we had this for 3 months, which is 12, 3 over 12. Abi, I would have said equals to 3 divided by 12. Why is this one in dates? Okay, and I would have said this multiplied by this. Sorry, I would have said this existed throughout the year, continued to exist throughout the year, and this one only existed additionally. Yeah, for 3 months. And this would have been my weighted average. All right. But the standard says, no, don't do it like this. Don't worry about the weighting. Don't worry about it. What you should worry about is this bonus. The fact that there is no exchange of any capital resources. You were not given cash. There was no exchange of shares. Nothing was given in return for it. So therefore, don't bother. Whenever it is bonus, for bonus, don't factor time or waiting factor. This is what this thing here that I've done here is what the standard calls the waiting factor. Say don't bother about it. This is not needed for bonus. Just go ahead and calculate your EPS like this. It is okay to say this is your one-offs. And say this is it. What is the earnings? My earnings was how much? Earnings was 800,000. Abi?
Yes, yes. For 20x2.
Yeah, that's current year. I'm dealing with current year. So my EPS here will just be this divided by this one-offs. 1 naira 60 kobo. All right.
What do you mean by one nurse? I mean, I just joined you.
Weighted average number of ordinary shares. All right.
Okay,
now, the standard now says you should go back to the immediate preceding year and say, in my immediate preceding year, what was my EPS? My EPS was how much? They told me 18 naira 7. Let me change it so that I can even look like this one small. Let me make it 1 naira 875. So it was 1 naira 875. So they are now asking you to calculate the adjusted EPS, all right, or restated EPS. You have to restate it in the current year. You will go back to the preceding year and restate the EPS. So what the standard said is that you did this thing, this 1.88, you must have done it by dividing by 400,000 shares in that previous year. Now change it to 500,000 shares. What it simply means is that I can simply say this multiplied by 400 divided by 500. This is going to be my restated EPS. Why did I first of all multiply by 400? I can get the earnings back. What would have been the earnings in the previous year? The earnings in the previous year would have been 1.88 is what we add. And we add it by dividing by 400,000. So for me to get the earnings, I'll just say multiplied. What did I divide by before? I divided by 400,000. Multiplied by 400,000. I divided by 400,000 initially. So meaning that the earnings I would have had in the previous year would have been this. So if you are now telling me to go back and not divide by 400, but divide by 500,000, then it means that you're asking me to do this divided by 500,000, which is what we have already done, 1.5. All right. So the way to go about it is to just say, instead of going through, just say, what was the previous year number of shares before? 400,000. Let me write it in full. What is the current one? 500,000. 400,000 divided by 500,000 multiplied by the former or the preceding year EPS. And that will give you the restated EPS. Is it clear now? Before I move on to right issue. Why is time always jumping when I'm in this class? All right. Let's move on. Now let's talk about right issue. So for right issue, similar but not the same thing. Bonus issue, they would have given you for free. They gave you for free. You didn't have to pay 1 naira. All right. For right issue, it will not be given to you for free. However, it will be given to you at a discount. And again, it is not automatic. What is the meaning of that? The company says, I am going to give you the opportunity. Let's say, for instance, the current market price before the issuance is, let's say, 5 naira. The company now says, for every 4 existing shares that you own, I am going to give you the right, you see, they said right to buy 1 new share at a discount. Let's say you can buy it at 4.50 naira. It's not free. But because you have shares in the company before, you are allowed to buy, meaning that you have an election to make, either to exercise your right and purchase, or not exercise the right at all and just leave it. I have existing shares, but I'm not interested in buying more shares from your company. I let it go. I don't know if you understand what I'm saying. So the difference between bonus share and right issue share. Bonus share is given to that is an existing shareholder based on the formula the company says they want to use. They can say for every 2 shares, we are going to give you 1. They can say for every 4 shares, we are going to give you 2. They can even say for every 1 share you own, we will add 2 more to you. That's bonus. However, when it comes to right shares, right issue, what the company is basically saying is that we are going to sell to you at a discount, meaning that on the basis of what you already own, we are going to give you a right. You can decide to buy or not to buy. But when you are buying, what we are using to attract you to buy is simply the fact that we will sell to you at a discounted price, which we call right price. That right price is usually discounted, meaning that it will be a little lower than what is the market price of those shares before the right issue came up. Is this understood? Is this understood?
Yes, sir. Yes, sir.
All right. Let's move on then. Now, what is the effect for right issue? What is the effect? because there is a bonus element there as well. Why is there a bonus element there? You are buying at a discount. You are buying at a discount. The note says to calculate the figures for weighted average number of shares when a right issue is made. We need to calculate, first of all, the theoretical X right value. All right. We'll look at the steps here. Step 1, calculate the theoretical X right price. Step 2, determine the number of right issue. Step 3, determine the bonus element of right issue by multiplying the right issue by the theoretical X right price minus right price over theoretical X right price. And step 4, we will add the existing ordinary shares to be paid to the paid right issued adjusted by time value, time weighting factor, and add the bonus element. We're going to look at it, meaning that it is composite in its own idea. Don't forget that I have taught you two different things before we got here. Number one is that there is a difference when you want to calculate EPS. The way we normally do when you are dealing with, when you are dealing with ratio analysis, in other subjects, you just say profit after tax. You divide it by the number of ordinary shares and you move on. The standard is prescribing to you. Your number of ordinary shares should be weighted average number of ordinary shares outstanding. However, we have said that you may have a technical case where there is increase in number of shares, but there is no increase in share capital. That is the exact issue with bonus. Bonus, there will be issuance of shares, but there is no money that has been received. Meaning that what the company has basically done is to just increase the number of shares. The amount of share capital did not increase. It's a way, it's like saying, how many of us have gone to party and you say, I have 10,000 and I want to spray at the party. So what I will do is I will redominate my 1,000 to 200 naira. So I will have many more notes. I will have many more notes, but the real value of what I have has not changed. It has not changed. So in terms of our book value, the book value has not changed. So the standard says what we will do is you are going to account for this new number of shares. However, you will not reflect any time factor, any time weight. You will not add it to it. You will not reflect it at all because these shares don't come with extra money. No resources is backing it up. It's just free. Now, we are now coming to right issue. Right issue combines these two things. There is an element of right issue that you are paying for. We must account for it. Now, there is an element of it that is a bonus, meaning that you have two scenarios here. So we must be able to divide it. And that is what these steps is telling you. That you first of all do an element where we are seeing what has been paid for. We see the element where bonus is. The element that is bonus will not factor time into it. The element that is not bonus will factor time into it. Let's go. After this, the next thing will be diluted EPS, and I can take that to the other class because of time. I know we're going to have classes, even myself, I'm going to have class from 8 a.m. 8:30 a.m. tomorrow till about 7:30 thereabout. So let's just move on so that I can end quickly. And then I'll know that it is diluted EPS that is left. We're almost there. Almost there. Just stay with me. Let's conclude together. All right. Say in 2007, all right, Abeco had a basic EPS of 105 kobo. Just take my C as kobo. Take that C as kobo. All right. based on earnings of 105,000 naira and 100,000 ordinary 1 naira shares. It also had in issue 40,000 naira 15% loan stock, which is convertible into no, sorry, this is
Diluted, you know.
diluted. Sorry. Did I not put question on that right? Then when am I going? Okay, why am I now going there? Okay, good.
Seems to have not eaten this night at all.
What did you say, sir?
I'm greeting you, sir. Well done.
Hey, how did you know? Suppose that Egghead Co. has 10 million shares in issue. It now proposes to make a 1-for-4 right issue at a price of 3 naira per share. The market value of existing shares on the final day before the issue is made is 3 naira 50 kobo. This is with rights value. What is the theoretical extra price value per share? So let me just quickly explain this one, this part, this one, because you may see it in your exam and they will not express it like this. This expression here is almost like I am trying to explain what it is to you already. What will your examiner already say? Say cum right. Those of us that are dealing with SFM will know this. Cum right, meaning that the right value is inside this 3 naira 50 kobo. What does it mean? If you purchase these shares as at this day, you will have the right to purchase at 3 naira. At 3 naira. If you purchased at 3 naira 50 kobo as of that day, you know, it is 1-for-4 existing, 1 new share for 4 existing, meaning that we are giving you right to buy 1 share for 4 existing units of share. Now, what they will count as existing, the cutoff day, is this final day that they mentioned here. So if I had bought shares in the market at 3 naira 50 kobo, this 3 naira 50 kobo is a cum right price, meaning that it is cumulative of the right price, because it gives me access to be able to purchase, all right, shares at the new discounted price. If I buy it the next day, I will not have access because I did not meet the cutoff day. So this 3 naira 50 kobo is exactly what we are going to refer to as the cum right price. So your examiner may put it that way. They may call it cum right price. They will not explain it like this. The market price value, the market value of existing shares on the final day before the issue is made. They may not express it that way. They'll just tell you cum right, and that's it. All right. So now, when you want to calculate your theoretical extra price, it's a very, very simple concept. Let's quickly do it. The concept is this. Let me just copy what I have here. Sorry. This reason. All right. So this is what we're going to do. I will say number of shares. Does not need this, elaborate workings. If you like, but it's also easier to get like this. 4 shares that I said is existing. What we call existing is this 4 number of shares. And they existed at 3 naira 50 kobo on the final day. At 3 naira 50 kobo. Meaning that if I bought these 4 new shares as at that final day, I would have got it for 14 naira. Now that will give me access to have 1 new share at a discounted price of 3 naira. And that will sum up to 3 naira. But now, what they are asking, when they say theoretical extra price, what they are asking me for is the weighted average. So what is the weighted average? I'll total this and I'll total this. Permit me to call this value. So what does this mean? It means the new price or theoretical X right
3 naira 40.
price is now going to be 17 divided by 5. These 5 shares cost 17 naira. So the price is the value divided by the new quantity I have, which is 3 naira 40 kobo. So you see, this question is just to play around. How do you calculate theoretical extra price? Very easy. Just do it like this. The existing shares I have multiplied by the cum right price. Then the new right multiplied by the right price. Whatever value I have, add it together. Whatever number of shares I have, add it together. Then do the new total value divided by the new number of shares. And then you have the new price, or what we call the theoretical extra price. Now, this new price, I call it new price, is not the market price. Oh. It is called theoretical for a reason. I won't go into SFM. I would have asked you what is supposed for CR students, corporate reporting students that are taking SFM. Your question or your assignment that you go and do on your own research is that in reality, the market price of the shares, after this right issue is usually lower than this theoretical extra price. Why? That's for you to go and find out. Why? You are confused at what? Madam Perry, you are confused at what? So that I go back. Okay, this theoretical extra price. Let me come back to that question. Okay, it's here already. They said suppose that Egghead Co. has 10 million shares. All right. In issue, it now proposes to make a 1-for-4 right issue at a price of 3 naira per share. Now, listen to this information. It says the market value of existing shares. Whenever they tell you 2 for 5, it means 2 new shares. Always interpret it that way. 2 for 5, it means 2 new shares for 5 existing shares. When they say 1 for 4, 1 new share for 4 existing shares. So they are now giving you information about these 4 existing shares. They said it used to be at a price of 3 naira 50 kobo. So what you will do is, what is the value of the 4 existing shares? Can put here existing. All right. Let me make it go to the right. Existing. And here I can put new. So what is the value of the new? The value of the new is 1 share at 3 naira. The value is here, 3 naira. Multiply price times shares. What is the value of the existing? 4 existing shares at 3 naira. This is the value. What do I now do? I will simply add these two values. This is the value of the 5 shares because there is 4 existing, there is 1 new share, Abi, and I'll come and do my theoretical extra price, and I'll get 3 naira 40 kobo. Is it clear now, Madam Perry? Please use the chat box like you did when you asked the question. So now let's calculate what will be the weighted average. You know, this one, in the steps I mentioned, I said the first thing to do, calculating the theoretical extra price, is only one of the steps. It's just the first thing to do. There's still more to be done. So what is the more to be done is what I want to show you now. In the next class, we'll look at diluted, and then we'll look at past question together. And then you see that it is a lot easier than you think. All right. So the second step says you should calculate the number of right issue and blah blah blah. But let's look at the next question. I will end it here now. It says Brains Co. had 100,000 shares in issue, but then makes a 145 right issue. All right. On 1st October 2012 at a price of 1 naira. Now, the market value on the last day of quotation with rights was 1 naira 60 kobo. You see, they keep mentioning with rights. Okay, what they are trying to say is that if you bought at this day 1 naira 60 kobo, or you add the shares as of this day when the shares was 1 naira 60 kobo, then you will qualify to have rights. All right. Okay. The solution says step 1, determine. Let me see if I can take this to Excel, and it will take it simply the way it is. It says determine the theoretical extra price. That's exactly what we're going to do. Okay, good. It says determine the theoretical extra price, determine the number of right issue, determine the bonus element of right issue by multiplying the right issue by theoretical extra price minus right price divided by theoretical extra price, and then add the existing ordinary shares to the paid right issue, having adjusted for time waiting factor, and then you just add the bonus element without adjusting for time element. Let's do it together. Let's do it together.
1 naira 50 kobo.
Okay, let's start with the, all right, let's do this. I'll just copy this down to calculate our theoretical extra price, right? So the question says,
One for
did I copy the question at all? I didn't. Brainsco had 100,000 shares. So, but then makes do it like this, 1 new share for 5 existing. All right, good. Now, this last day market value price is the price of the 5 existing. This 1 naira that they say they are issuing their right is the price for the 1 new. Okay, so that makes life easy for me. So what I'm going to do here, I'm just going to adjust this. It's no longer 144, it's now 5. 145. This is 1 naira 60 kobo. All right. And then this is one new share at 1 naira. Okay. All right. You can see what I have is 1 naira 50 kobo as my theoretical extra price. All right. Good. So now the next thing to do is to determine the number of rights. Abi, the number of rights that we have. What did the question even ask us to do? Question says we should calculate the number of average, the weighted average number of shares. Good. Sorry. Determine the number of right issue. Now, the number of right issue is simple. This will be equals to, did they give us, sorry, did they give us the time that they introduced this? They did not give us. They did, but we don't know the year end. All right. Okay, no problem. Number of right issue anyway would have been 1/5 multiplied by how many shares do we have normally? 100,000, I mean,
20,000.
or is it 10 million? 100,000. That's 20,000. So these are a number of right issue. Then they say we should do the bonus element. We'll be able to do that one too. Bonus elements. The bonus element, they said
100 over
we should
120.
multiply this by, so let me start like this. Right issue is here. But now multiply X right price. This is X right price here minus X right price minus the right price. The right price is 1 naira. All right. Can put that in bracket. Divided by the X right price, which is still 1 naira. This is what I have. They say I should multiply this
But I
by
thought it's over
this.
theoretical X-ray price.
Is that not what I did?
No.
C57. Okay, sorry. Divided by this. Okay, good. Now this is the right element. I will need to add an assumption to the question. All right. Now, this is the bonus element. This is the right issue. So what did they say? They say add the existing ordinary shares. The existing ordinary shares I have existing. So the other time, did I put head into it? Waiting factor. Good. So now I can say weighting factor. So now I can have existing. I'll have 3 layers. Existing. We are going to assume they paid for all the right issue. You know, I said it is right. They can decide, the existing shareholders can decide to take the right, they can decide not to take it. So for simplicity's sake, I will assume that they took it. So what was existing number of shares? 100,000. Abi? Let me call this number of shares. You wanted to ask a question, Mr. Latif?
This how you came about this bonus element.
Okay, you want me to go back to it?
Sorry, please.
Well, we are just, no, there's no problem. We are following this. This is what we did. Let me just color it. So the standard says that to determine the bonus element, what should we do? We should multiply the element of right issue by theoretical X right price minus right price divided by theoretical X right price. Did you see that? So that was what we did here. So what we did here was to say theoretical X right price is 1 naira 50 kobo. Right price is 1 naira divided by 1 naira 50 kobo. That's how I got this. Now when you multiply it by the number of right issue, you will get 6666.67. All right.
Yes, sir.
So now we can now go ahead and calculate. You know, I said it the other time that there are various elements, there are two elements to it. There's a right issue, this one that was paid for. That element, we are going to affect it with waiting factor or waiting time factor. I mean, time waiting factor. The bonus element of it, we said we should not be affected by it anyway. So this is 20,000 and this is 6666.67 because of the decimals. Let me put it here like this. Now, I'm going to make an assumption here. All right. This existed throughout the year. Okay. I'm going to assume that the year end of the company, the year end of the company is December. When did they do right issue? They did right issue in October. We assume it is October 1st. So we will count 3 months: October, November, December. So I'll do 3/12, yeah? And yeah, because it's not supposed to be affected by weighting factor, I'll just say ×1 there. This will be the weighted average number of shares. We'll pick it up from here in the next class. So yeah, I will say weighted, or let me just call it one-us. All right. So this is what it entails when there is right issue. I'll not rush into diluted before we even go ahead and do diluted. Okay, we might even do diluted. The questions we are going to face will ask us to do both basic and okay, you want me to share the Excel? Are you sure if I share the Excel, you'll be able to make sense of it? No problem. It's not a problem. I can share it. Okay. So that is that. Do we have any question? That will be all for tonight. We'll come back to it again on on Friday. Seems Mr. Asi is not through with the class. So it will have to be Friday again. In our separate class, we'll pick up IAS 12. CR student on Sunday will pick up IAS 12. FIL student will pick up IAS 12. So we'll be dealing with IAS 12 in our separate classes. But when we come together on Friday, we'll round up on IAS 33. I think the basics has been set already. So we shouldn't waste time with that one. And then after IAS 33, we can move to IAS 37 in the joint class again. All right, that'll be all for tonight. Thank you for staying with me. But if you have any questions, please let me know. I'm going to share the solution, FR students. I'm going to share the solution for the cash flow. I acknowledge what everybody did by saying you did well, not because you did everything well, but because you attempted and I saw elements of progress. So I'm going to send out the solution and I'll send out more questions for you to do. Do you understand?
Hello, sir.
Allow me to.
Well done, sir.
Good evening,
So,
Mr. Latif.
good evening, sir. Somebody made me to understand that last year question, there is what the group cash flow.
For FR,
Yes.
no, they can't give you group cash flow.
Okay.
I don't
Okay.
think so. I'll go and look at the question. I'm sure it can never be consolidated cash flow. I'll go and look at it. People overestimate some things at times. I'll look at it. Don't worry.
Yes, sir. Thank you.
It is for CR students, and it is with CR students we did consolidated cash flow. It's part of the CR syllabus. It's not part of the FR syllabus at all. All
Okay, sir.
right. All right. Thank you. Because there are a lot of the CR students will know why they cannot set it at FR level. At FR level, you would not have dealt with disposals of subsidiaries. At FR level, you would not have dealt with piecemeal acquisitions.
Hello, sir.
I'm with you.
Before the next class to round up this IAS 33, would this video be available by then? Before then,
Of
rather?
course, it will be available.
Was
It will
late
be
stage.
available. It will be available. In fact, this Excel that you guys are asking me to share, let me prepare to share it immediately. All right. Thank you very much for your time. I'll see you again in the next class. It promises to be a better one because we'll put an end to it. We'll solve questions. I'll pick past questions, maybe 2 of them that will be basic and diluted. And then we'll do it. We'll do the 2 together. All right.
Yes,
Thank
sir.
you.
Thank you.
All right.
Yes.
Bye.